Hello, ladies and gentlemen. Good evening. So hope all of you are doing well, your family and friends included. I think we had the last Rising Giants webinar sometime in February. So good to connect with you again after a gap of 3 months. So I'll just share my presentation for the day. Yeah. So let me jump directly to the issue on the hand. So obviously, since the inception of Rising Giants PMS, this is how the returns look like. So we are this is the return as of 11th May. So we are down close to 21 odd percentage points, and compared to the benchmark BSE 500, which is down close to -5%. So this is where we stand as of today, as far as the return is concerned. And the table on the right hand side actually is the stock wise attribution. So you'll find that the many of the stocks on the right hand side they are down anywhere between say 20 percentage points to some stocks even more than 30 percentage points. So obviously it's not a very ideal situation to be in. So we'll try to address in today's webinar, how we are going about it and what gives us confidence of the fundamentals of the portfolio stocks. So first and foremost, what are we doing about addressing the underperformance is first track the portfolio stocks, business and fundamentals very, very closely. And honestly speaking, this is not a bear market reaction. Actually, this is what we do, whether it is bull market, whether it is bear market, not to lose the sight of the how the company's business is shaping up, how the fundamentals are shaping up. So this is something which we do across the cycles. As I said, like whether it is bull market, euphoric market, or whether it is a bear market or pessimistic market. This is the thing which we come every morning and every day, whole day. We actually do these things, track the portfolios, business, how it is shaping up, how the fundamentals is shaping up. Having said that, we have made one portfolio change in the Rising Giants PMS in the last 2 to 3 months. One is we exited from Endurance Technologies and we have got into VMart Retail. The reason for exiting from Endurance Technologies is that we see some structural challenges to the margins and earnings of Endurance Technologies. One is obviously it has a manufacturing operations in Europe. And as you know that the gas prices in Europe has increased tremendously in the last 5 to 6 months, even before the onset of the Russian-Ukraine war. Gas has been prices have been rising. And one thing is that while the OEMs do compensate for the increase in the prices of raw materials like steel, aluminum, gas price is something which is not covered in the OEM agreements. You have to actually fight it out for getting the increases in the non-raw material operational cost. So this is one challenge. Secondly, we also see, Endurance is winning good orders as mentioned in the last results call. But most of these orders need to be catered through by setting up new capacities, new plants, rather than being fulfilled in the existing plants. So this kind of limits the operating leverage benefits that would have otherwise flown if these orders or new business wins would have been catered through the existing plants. So that is also one challenge we see, in terms of margin as well as on the free cash flow generation. So as a result, even when the stock was down almost 30%, we actually took a call to exit from because we see a little bit longer road to recovery for the earnings in case of Endurance. On the other hand, we have got into VMart Retail. We have always been fan of this company. So VMart Retail, one of the most efficient retail manufacturer, as evident in its working capital days. As I said, as I've been saying before, I think one parameter if you have to gauge any retail company, look at the inventory days or look at the working capital. So VMart has kind of the best inventory days, the best working capital cycle in the retail business. And also its business has only strengthened through the COVID. It has bought unlimited stores from Arvind Lifestyle. So that also actually increases presence of VMart in the southern market. So far, VMart has been largely present in the north and to some extent in the eastern market of India. So this acquisition also helps VMart get a presence in the southern market. And also VMART has kind of improved its balance sheet. One is obviously it has maintained that cost discipline. It has been one of its forte, and also through QIP, it has actually its balance sheet is in a very strong position to take advantage of the recovery, that is undergoing as the lockdown has now come to an end. So there is an increase in footfalls that is seen across India, across the retail space. So VMART is kind of geared to benefit from that. And finally, obviously, when there is a market dislocation, it also means that there is a lot of movement within the portfolio. For example, model portfolio has allocation, say 10% to one portfolio, but if to one stock, but if the stock has not done well, it is quite possible that its allocation in actual portfolio would have fallen significantly compared to its model portfolio allocation. The market dislocation has meant that some of the good companies, which have seen steep price correction, and where there is a huge deviation in their actual portfolio versus the model portfolio, we have kind of increased the allocation to those stocks by trimming the positions in those stocks which have relatively done well. Obviously, we need to be convinced about the fundamentals of these companies where we are increasing the position. But having convinced ourselves of the fundamentals of these companies, we have use this price movement opportunity to increase the allocation to some of the stocks. For example, we increased, given Dr. Lal has been fallen one of the most in the RG portfolio, we have been increasing the position in Dr. Lal. And this we will continue to do so. For example, last few days also market has seen some steep correction. So this will be a regular feature wherever we see opportunity to increase the position and make use of the price opportunity given by the market, we will continue to do so. So that remains our strategy. And why we remain convinced about the fundamental, I think this is the biggest kind of important part of the presentation today. Why we remain confident about the portfolio company's fundamental prospects. So there are four parts to it. One is looking at the track record of these companies sustaining their fundamentals to various cycles. So I'll come to each of these pointers. And then we are seeing a clear acceleration in the earnings of these companies in the last 1.5 years. So COVID has only kind of strengthened the position of these companies. So I'll cover that in a bit. And thirdly is that these companies have really used COVID as an opportunity. Given that most of the peers of these companies are in pretty bad shape, we are seeing a very heightened capital allocation initiatives by these companies. I'll come to some of the examples. And these capital allocation initiatives, we think, will augur well for the earnings growth of these companies for the coming years. And finally, we also there are near-term imminent headwinds like raw material price inflation, etc. And we also discuss the track record of these companies in dealing with this raw material price inflation. And hence, we think, barring 1 or 2 quarter impact, we think, this headwind should really not impact these companies on a structural basis. So coming to the first part, the companies, if you look at this table below, this kind of captures the fundamental performance of the various companies across 3 different time periods. That is FY12 to 15, FY15 to 18, and FY18 to 21. And as most of you would know that, none of this, I would say, none of these time periods, we had a kind of very strong macro cycle in any of these time periods. For example, FY12 to 15, many of you will remember that rupee had kind of went up to 70 somewhere in the middle of 2013. Similarly, economy for most part of this FY13 to 15 period was not in a pretty good shape. Similarly, FY15 to 18 period, there was a demonetization, there was GST impact, and again, this time period was also a bit of challenging. And finally, FY18 to 21 time period was also fraught with a lot of macro challenges, particularly, even before COVID kind of hit us in March 2020, we were facing macro slowdown, beginning FY20. And then obviously COVID hit home in March 2020 and has been an ongoing feature through most of that time period. So despite these macro challenges, one thing you will observe that when you look at the EBITDA column of the portfolio at the bottom, the median, which represents the portfolio median performance, you'll find that these companies have been able to maintain the healthy operating profit growth. So 26% in FY12 to 15, which similarly, 19% in FY15 to 18, and 18% in FY18 to 21. So despite the macro challenges across all of these time periods, these companies have been able to maintain their operating profit. So that gives us a lot of confidence that if one is to ignore the near-term headwinds, which will impact 1 or 2 quarters, when you look from a 3-year time period, these companies have adequately demonstrated in the history that they are able to grow their profits. In other words, these companies have they are not kind of delinked to what happens in the macro. I'll come to that aspect. In other words, irrespective of the macro, these companies have been able to maintain their healthy earnings growth. And this gives us a lot of confidence that in the current environment also, these companies should be able to sustain the growth in the operating profits when one takes a 3-year time horizon. Also, what has added kind of an icing on the cake is in the last time period, FY18 to 21, and we have been discussing this in Rising Giants portfolio. What has also come to the party is the cash flow compounding for these companies. Because what happened in FY12 to 15 time period, while the operating profit was healthy, but these companies were very small, and hence the size of the operating profit was not able to cover or meet fully the reinvestment needs. And hence, most of the operating profit used to get consumed in reinvestment. And hence, there was no cash generation of these companies. So hence, when you look at FY12 to 15 time period, you'll find that the CFO, which is operating cash, and FCF column, the numbers are not very high compared to the EBITDA growth in that time period. But as these companies started increasing their size, the operating profit started becoming bigger. While these companies continue to maintain their reinvestment, ऐसा नहीं है कि there was a slowdown in the reinvestment, but the growth in the operating profits started outpacing the growth in the reinvestment. And hence, we will find that FY18 to 15 to 18 time period, the operating profit and FCF, there was a gap which started opening up between the operating cash, FCF, and the operating profits. And that kind of increased significantly in FY18 to 21 period as these companies continue to compound their operating profit. Really more and more operating profit started flowing into the cash flow, and hence you'll find that there is a real exponential growth that we are seeing in the operating cash as well as free cash flow growth in FY18 to 21 time period. And this is one of the important theme of Rising Giants. We believe that this is just a start of the exponential or exceptional free cash flow compounding for these companies, and we expect that this should continue for several years to come. So this is the fundamentals through cycles. I'll come into a little bit more deeper, why these companies have been able to evade the macro slowdown and grow their fundamentals. But also I would like to highlight the comparison with the benchmark fundamentals, BSE 500. Again, when you look, there is a significant gap, whether we look at any parameters, whether it is EBITDA, whether it is free cash flow compounding, or whether it is RoCE. You'll find that there is a double digit in most of the time periods. There is a double digit gap between the portfolio fundamentals and that of the benchmark BSE 500 fundamental performance. So this is kind of demonstrates the divergence in the quality of the portfolio companies in Rising Giants and generally in the BSE 500 index. This fundamental difference in the fundamentals of both this character. And now, why these companies have been able to kind of evade the macro slowdown and still grow their operating profits? One important pillar has been market share gains. And we have been highlighting again in our webinars that structurally the economy is shaping up in such a way that it's becoming more and more in favor of the strongest companies, like for example the improved road connectivity, the internet connectivity. So what is enabling is it is breaking down the barriers which hitherto actually protected the regional players, which protected the smaller players. So now even the bigger companies, with help of better infrastructure in the country, with a better internet penetration, they are able to reach the customers in the remotest part of the country. I think that is one important macro change which is helping the stronger players in each sector. Second is obviously the formalization of the economy, whether it is demonetization, whether it is GST, that also actually helps the stronger players. And finally, technology is becoming more and more. So 25 years back, when we talk about technology, it was mostly global giant companies who had access to technology. But as technology is becoming more modular, more like cloud and SaaS oriented, I think these rising giants companies, similarly other companies in our other portfolio also, they are adopting this technology, and that is also playing to an advantage. So as a result, courtesy these changes in the macro level and because of the adoption of the technology by companies, they have been seeing market share gains in the, whether we talk about last 3 years or last 5 years particularly, there is a strong market share gain sector after sector in favor of the stronger players. And that has also helped rising giant companies because by default, rising giants companies are either number one, number two, or number three. That is what what our investment philosophy is, and they have been gaining market share. So we are given some comparison with of some of the companies with what is the general growth. For example, in specialty chemicals or chemicals, alkylamine and Galaxy growth has been pretty ahead of that of the generally BSE 500 chemical companies. Similarly, the lenders in our portfolio, Cholamandalam as well as Aavas, they have been able to grow their loan book much faster than what has been the overall growth of the NBFC sector or the housing finance company sector. Similarly, Page Industries, despite facing some challenges in FY 18 to 21 period, where it kind of lagged the growth of that of its peers because of company specific issues. But when you look at the 5-year time period, FY 16 to 21, it was still ahead of the industry growth. So I think this is one important pillar. Market share gains has been one of the very important mitigating factors for rising giants companies to kind of mitigate the impact of the economic slowdown and on their earnings and still post good profits. And this is something which we expect to continue because we don't think the story is over. I think when I talked about the acceleration in the earnings, I will touch upon that. But COVID is actually kind of, we think this will, COVID and disruptions, etc., will only accelerate this pillar of growth for the rising giants companies. Second important aspect of profitability improvement for rising giants company has been the margin improvement. So there are some figures which you can see in the blue font. So these are all companies which have seen significant improvement in their operating margin in the recent years. And this is not because of any commodity tailwinds. Actually, Sanita, ki there was any sharp deceleration in commodity prices or crude prices, that kind of aided. But most of this margin improvement has come because of 2-3 factors. One is obviously the scale benefits, because as the company gains market share, gains volumes, there is an operating leverage benefit which these companies benefit from. Second is again something to do with market share, because as you gain market share, as you become dominant, your pricing power generally increases in the industry. So you're able to command a better pricing from your customers. I think that is another structural change which has helped margin improvement. Then there is obviously again, technology actually has impact across the board, whether it is top line, whether it is margin, whether it is working capital. So again, improvement in technology, automation, a better inventory management system, etc. Again, that has also contributed significantly to the margin improvement of the rising giants companies. And finally, and probably the most important, is these companies, company after company in the rising giants portfolios, they have seen an improvement in the product mix. For example, some of the examples which I can highlight is alkylamines. For example, alkylamines has been seeing an increase in the share of the value-added products like amine derivatives or specialty chemicals like acetonitrile in the recent years. From largely focused on amines, basic amines, now a sizable revenue for these companies for alkyl comes from amine derivatives and acetonitrile, for example. So there is an improvement in the product mix. Similarly, Grindwell Norton, historically significant or dominant part of its revenue used to come from abrasives, but now more and more revenues are coming from value-added products like performance plastics, for example. So there is a structural, again, courtesy the R&D efforts of these companies, the product mix of these companies have improved. And I think that has contributed again significantly to the margin improvement of these companies. So again, none of these are kind of a tailwinds, but more structural and more enduring factors. And that also gives us confidence that, the margin improvement, again, there will be some short-term impact of commodity, but when we say structurally speaking, the margins of these companies are on an upward trend. And another aspect of the fundamental performance of this company is the working capital reduction. Obviously, this doesn't benefit the profit and loss account. This more it reflects more on the cash flow impact. But again, there are two factors which has helped the rising giants companies reduce their working capital. Again, the investment in technology, like supply chain, better tracking of supply chain, better inventory management system, and so on. I think that has contributed significantly to bringing down the working capital. Unfortunately, because of FY21 and we had the second wave of COVID, some of the companies actually got impacted. The inventory, for example, got impacted. Otherwise, the inventory days actually which were could have been even better in that period. But because of the second wave of COVID, the inventory, if you look at some of the companies, the inventory are on a higher side. That kind of masks the benefit of the technology investment of these companies. But again, structurally speaking, working capital is on a downward trend. And secondly, again, something to do with market share is, as these companies are becoming more and more dominant, they are able to command better bargaining power, not only on the pricing front, but also on the working capital front. So whether from your customers or whether from your vendors. So jab aap chote the, when you are small, you don't have that bargaining power. So you have to give higher credit period to your customers. Similarly, you have to pay your vendors very fast. But as you grow in size, you become more and more important to the customers or vendors. You are able to command better working capital, better credit days, or you are able to pay at a slightly longer time period to your vendors. I think that is also a structural factor which is helping the working capital of these companies in recent years, and which we think will sustain in the coming years. So that is on the working capital. And finally, these companies have continued their reinvestment engine. So as I said, like FCF, actually counterintuitively, you think that higher FCF should impact, higher reinvestment should impact the FCF generation, but it is not so. If you actually stop your investment, it will help your free cash flow generation in 1 year, but it will be counterproductive because your operating profit for the future years will not grow. So you have to keep your reinvestment engine on, and this is what rising giants companies have done. So if you look, despite being COVID and lockdown, etc., the absolute amount of the spend reinvestment of these companies at 1.8 billion that you see at the median level, it's almost similar to what was at FY16 to 18 period, and substantially higher than what was between FY13 to 15. So these companies have continued to invest. They continue to invest in capacities. They continue to invest in expanding the distribution. They continue to invest in technology and new product development. So the reinvestment engine, these companies have kept it on. And I would say that has also contributed to growth in the operating profits. And that has also played an important role in the performance of these companies in the recent years. So all this actually, these are the drivers of the performance of these companies through the last 10 years. And this track record gives us a lot of confidence, again, that, even in future years, they should be able to sustain. And one positive thing which we have seen is there is a clear acceleration in the earnings of these companies in the recent quarters. Obviously, third quarter, there was some impact in some of the companies, but when you look at a 9-month time period, I think when you look at the revenue column, or whether you look at the PBT column, you will find that those are marked in red circle. So those are substantially better than the FY21 period. So again, as I said, these companies structurally benefit from crisis, whether it was demon, GST, or COVID, because there is a lot of market share gain opportunities, and that has helped these companies accelerate their earnings, top line as well as PBT growth through the COVID, because clearly there is the market share gain is happening at an accelerated basis. So this is one again a positive data point for us. Ki COVID crisis ke time bhi these companies are able to not only sustain, but they are able to actually accelerate the earnings, their earnings. So this also gives us a bit of conviction. And finally, not finally, second last point we think is that the reinvestment in has only again it was high in FY19 to 21 period, but even in the last 2 years, when we look at particularly 21 and 22 period, the reinvestment has actually these companies have actually pressed the accelerator on the reinvestment. So we are highlighted some of the important capital allocation initiatives in this slide. For example, acquisitions. Dr. Lal Path Labs, Suprajit, GMF Folder has made almost 3 to 4 acquisitions in the last 2 years. Similarly, organic, for example, alkyl amines. We are seeing a lot of organic expansion by these companies. And finally, these companies are some of the companies also enter into new business segments. For example, Chola has recently forayed into beyond vehicle finance. It has forayed into SME consumer finance. So, and we think most of the benefit of this capital allocation initiative is still not captured because most of it is, for example, Suprajit's acquisition of Kongsberg or GMM's full potential of acquiring its parent, Podler. Those will come in the coming years. They are still not captured in the 9-month FY22 or FY22. And this gives us a lot of confidence. This capital allocation initiatives in the last 2 years, we think this places these companies on a very advantageous position for growing that earnings. And hence, again, when we look from a 3-year perspective, next 3-year perspective, we think it should be even better than what these companies have delivered over the last 10 years, because of the actions, capital allocation initiatives taken by these companies in the last 2 years, jiska benefit we will see in the next 3 to 5 years. And finally, obviously, there is a near-term headwind surrounding supply chain issues and raw material. Again, what gives us confidence is looking at the track record of these companies with dealing with the raw material price inflation. So this is again, intuitively, most of these companies are dominant market share, ranging anywhere between 30 to 60, 70% market share. So that gives us a lot of confidence about the pricing power of these companies. Secondly, a lot of portfolio companies are present in a resilient end user industry, whether it is catering to the pharma segment or whether it is catering to the food industry or whether it is catering to the personal care industries. So that also gives us confidence because of the relative demand inelasticity in these industries, these companies will be able to pass on the pricing in the commodity price inflation. And we are given in the below in the table below, we have analyzed the last 10 years of these companies' gross profit. So we believe that gross margin may not be a very good measure comparing YOY, for example, change in the gross margin, because gross margin gets impacted by your commodity pass on, etc., because it changes your top line denominator, and hence gross margin may not be a very fair measure. Instead, what we have done is we have looked, when we look at the rolling 4 quarters for the last 10 years, how many times this company has seen YOY decline in the gross profit. So that is a measure, YOY change in the gross profit is a better measure of pricing power. So what we have found to our comfort is that only 10% of the time in the last 10 years, when you take a rolling 4 quarters, only 10% of the time these companies have seen YOY decline. In other words, only 1 out of the last 10 years, these companies have seen YOY decline in their gross profit. So that speaks a lot about the strength of this franchise. They command a very strong pricing power. So not only intuitively by their dominance because of the presence in resilient industries, but when you look at even the hard numbers, when you look at their performance in the last 10 years, that gives us a lot of confidence. And in fact, if you remove 2 COVID impacted quarters, actually that 11% will come down to 5%. So even so 95% of the time, these companies have been able to post YOY positive growth in the gross profit. And finally, even if you assume कि 2-3 quarter इनका impact होगा gross profit का, it again actually structurally places them on an advantageous situation, because most of the peers of these companies, they operate on wafer thin margin. When I talk about wafer thin margin, it is say like mid single digit margin. तो उनके लिए, while most of these rising giants companies, if not all, they trade in double digit margin. So they will be able to absorb the near term impact of commodity prices. But the peers who operate on single digit margin, low single digit margin, who operate on very leveraged balance sheet, उनके लिए even 1 or 2 quarters of pain, it raises question about the sustainability of that business. So in other words, every crisis, similar like COVID and even this inflation issue, what it will help is rising giants companies to wipe out their competition, and hence, from a structural perspective, from a market share perspective, we believe the portfolio companies will be placed even better through this commodity price inflation. And finally, I believe that some of you may have questions surrounding the valuation of the companies. Valuation of these companies. So similar to what we did in the CCP webinar a month back, we have given both the price to earnings trend of these companies as well as the price to free cash flow. So similar to observation we had in the consistent compounder portfolio. So one is that the PE expansion, when we look, it is except for one or two companies, for example, alkyl amines, there is a significant, there is an increase in the PE compared to what it was FY16 में जो था, and FY21 there is a re-rating which has happened, primarily because alkyl amines used to trade at low single digit PE, and obviously now it has got discovered, etc. The PE has increased, tripled, but that is because the base itself was very suppressed for alkyl amines. So PE for most of the companies, it has not increased significantly. So as you can see in the slide in front of you. And secondly, when you bring price to free cash flow in the equation, you will find that the orange line actually represents the price to free cash flow. Find that most of the time for most of the companies, the free cash flow, price to free cash flow band is actually lower, substantially lower compared to the price to earnings band. So in other words, PE पे ज़्यादा expand नहीं हुआ है, and even when and considering P by FCF, actually there is a huge gap between price to earnings band and the price to free cash flow. So when you take when instead of earnings, when you bring free cash flow measure into the valuation, these companies actually have not seen the kind of the re-rating which has happened in the price to earnings part. And again, I would like to clarify that the price which we have used for calculating both the PE as well as the PE by FCFF band over here is the price at the respective years. So it is not that we are using current price and using the earnings of those time period. So उससे क्या होता है कि वो earnings would look, so it is not, we have not done that trick. So basically we have used the respective. For example, if we are calculating the PE of FY16, it is the EPS or the FCF of FY16 and the price or the market cap on FY16. So so we have done that adjustment. So this hopefully will give a comfort to you, who may have questions surrounding the evaluation of the portfolio. So this is where we are. And finally, just to give you the flavor of little bit underperform is also due to the stocks which has run up in the BSE 500. Actually, when you look at the list of the stocks which have done the best in the BSE 500, you will find that most of the stocks are either in power segment, or they are in energy, or they are in infrastructure, and so on. Which have done the best in the last 6 months or the last 1 year. And we, probably we, even with hindsight benefit, we may not invest in these companies because it is very difficult to get a predictability about the earnings of these companies. Or generally speaking, even the corporate governance in some of these sectors. So as an investment philosophy, these sectors we don't invest in these sectors because of the lack of predictability, and even to some extent the governance challenges associated with some of these sectors. But unfortunately, these are the stocks which have done very well in the last 6 months, 12 months, and that has also helped the benchmark BSE 500 in a relative basis. So this is I'd like to end the presentation, and happy to take the Q&A.
Thanks, Ashwin. So as expected, some of the questions you've already answered. Particularly, I think the elephant in the room is around valuation. I'll try and rephrase. I think you've addressed the fact that earnings multiples have expanded in some cases, but overall that hasn't been the trend across the portfolio. And certainly free cash flow multiples, if at all, have actually declined for the portfolio. So there isn't much reason from a multiple basis or a relative basis. But what about on an absolute basis? On an absolute basis, how do we how do we justify it? Because I think a lot of people are asking the fair question. Some ways, the fundamentals that you shared are clearly quite impressive. How do we reconcile these impressive fundamentals, improving fundamentals, better than peers fundamentals to the weak share price performance on an absolute basis, weak share price performance relative to the index as well. Index in some sense, I guess you've explained a lot of the stocks in the index which have pulled up the index are sort of stocks we wouldn't be considering for investment. But how do you think about absolute valuation in the face of this improving fundamentals?
Yeah. So I think there are two parts to the question. One is on the absolute basis. I would say the median price to earnings for the portfolio is close to maybe 50-55x. While I think most of the people would say that is an expensive valuation, but as we have discussed in our previous interaction, we have a different way of looking at valuation. So we look at the longevity of the earnings, longevity of the cash flows. And basis that framework, we arrive at what is the intrinsic valuation of these companies. So as I think Rakshit, Saurabh, Pramod, you yourself have shared the equation. So just taking a simple example, if the company is able to sustain earnings growth of 20% for say 20 years, which I would believe most of the rising giants companies should be able to do it. I think the deserved PE multiple, even if you take a simple DCF, use a cost of equity of 12-13%, I think the deserved price to earnings multiple of that company should be somewhere, I think 150 to 200x. So in that context, actually the absolute valuation of the companies actually is, current valuation of the company significantly in the money when you compare it to the intrinsic valuation of this company. And secondly, obviously we have that measure. So it's not that we don't take valuation into consideration, we blindly invest in the company, but this is how we measure the valuation. So there is a way of arriving at the intrinsic valuation. So a company with 90-100x may also make it to the portfolio, provided its intrinsic multiple is significantly ahead of that 90-100x. Similarly, a 20x company may not make it to the portfolio if the intrinsic multiple, using the equation which I said, is say like 15x, but that company is trading at 20x. So for everybody, that company may look very cheap, but in our eyes, that company is actually expensive compared to the deserved multiple of that company. So this is how we look at the valuation. Pramod, the second question I just missed it. I think
I think
the benchmark performance we discussed. I think benchmark probably bull market or the last 6 months is not probably the best period to compare the performance of the portfolio with that of the benchmark. But this portfolio has precedence. Like for example, even though Rising Giants was not in existence during the first wave of COVID, but I was just pro forma calculating the performance of Rising Giants portfolio. It would have fallen in the month of quarter of March 2020 by 20-25%, similar to the numbers which we saw for the actual portfolio since inception. But it has then subsequently bounced back very, very strongly. So we believe that is the case. This is a kind of a short-term time period where kind of the investor reactions, sentiments, and share price performance. There is a disconnect between that and the fundamentals of the company, and eventually the share price, everything should revert to the fundamental performance of the portfolio.
Great, thanks, Ashwin. So the next question is about the rebalancing that you talked about. So people are saying that, look, at some stage we've also talked about letting the winners run. Why then cut the winners and buy the weaklings? In fact, one other investor has asked the question exactly opposite. Shouldn't we, in a falling market like this, should we buy more of the winners and cut the losers? How do we explain our rebalancing approach?
Yeah. So two things to it. One is that obviously, if one is to take a 3 months time period, it may be possible that we should remain invested in the winners. But when we are taking a longer term time period, 3 year, 5 year, then that approach approach may not be the best. So ultimately you have to look at the fundamentals. So if you are convinced about the fundamentals of the companies which have fallen the most, and if, for example, the intrinsic valuation of that company versus the current market price of that company, if the gap between of that company of the stock is significantly higher than the other companies, I think it is but reasonable or natural to invest where the risk reward has become more favorable. But again, provided that you remain convinced about the fundamentals of the company, there is no structural issue in the company, you maintain your intrinsic value, you maintain the scores of that company. I think the gap, if the gap widens between the current market price and the intrinsic valuation, I think that is where we see the risk reward from a 3-year perspective, and that is where we kind of put in more money. But again, we are taking a little bit longer time period. I think that is one important aspect. And secondly, we should remain convinced about the fundamentals of the companies where the share price has fallen more. I think that approach will eventually make you more money over a 3-year time period.
Right. Thanks, Akshay. The next couple of questions, I'll perhaps have a shot at answering it. An investor has asked, you guys always pretty much invest everything in one go. Doesn't this experience suggest that that's not prudent? Perhaps if you had waited, you might have gotten better prices. So I'll make 2 points. One is, of course, if we had known for sure that these stocks will be available at 10 or 20% lower prices, we would have also loved to enjoy the benefit of the lower prices. As we've always maintained, we don't have that ability, unfortunately, nor have we met too many people, or in fact anyone who has that ability. And therefore we try and we don't try to time the market. We don't take any cash calls. Once you've given us the money, we believe you made the asset allocation decision that this money needs to go into equities. Our job is to ensure your money goes into the best equities based on the investment philosophy that we've articulated over time. However, we do have an STP option. STP stands for Systematic Transfer Plan, which means that, let's say you're investing 1 crore. In the lump sum option, of course, if you invest 1 crore, we will pretty much end up buying the entire portfolio in the next few days, subject to liquidity of the underlying stocks without having any sort of timing element to it. However, if you choose the STP option, we will deploy only 20 lakhs of that in the first go, and put the remaining 80 lakhs in a liquid fund. And every month on a prefixed date, and this is important, this will have to be prefixed and systematic in nature with no discretion on our behalf or your behalf, because if we apply that, we're going to be making another mistake in terms of timing it there. So every month on a prefixed date, let's say the 7th of the month or the 10th of the month, 20 lakhs is redeemed from your liquid fund and used to buy the underlying stock. And therefore, over a period of 4 months, you will be fully invested. Now, the benefits of these is, like in a falling market like this, you will end up getting lower and lower entry points. And therefore, you might see that as a benefit. And also, get comfort that you have some dry powder should the market correct substantially. We do offer a one-time liquidation. For example, you have 2 installments invested, let's say 40 lakhs invested and 60 lakhs still pending in the liquid fund, and we have a sharp correction in that month, and you feel comfortable that, yes, I would rather go all in now. You can call us up and say that, look, liquidate the entire liquid fund and buy the portfolio. What we don't allow is say that, okay, why don't you put the 3rd tranche now, let the 4th and 5th be. That's going to be operationally challenging. So that way you can choose to not do the lump sum investing. But in either case, we say that over longer term horizons, the eventual difference is not going to be material. Of course, in the shorter term duration or horizon, it will make some of the difference. But we've always maintained in equities, we would need at least a 3-year horizon. The small and mid caps, of course, even longer. And over those longer term periods, the differential in both cases is going to be minuscule. One other thing about the STP you should know is it is quite possible that the market starts rallying, in which case, if you are doing an STP, your eventual entry price could be higher, but that's the cost of having your options open. The second question, sort of related, is in terms of asset allocation. People are saying that, look, given this, should we shift back into cash or say put it into bonds? Or some say maybe shift to CCP and so on. So all these questions boil down to asset allocation. Like I said, the asset allocation call is ultimately yours, or if you have an advisor, between you and your advisor, you need to decide how much of your assets need to be in each asset class, or for that matter, a portfolio is also in some sense the CCP versus an LCP or a rising giants is also having a different combination of risk and return. And that depends on your overall financial plan. Depending on your overall long-term objectives, you need to keep your asset allocation intact rather than trying to time your entry and exit into certain asset classes. We don't recommend that. So, which is why we say that stick to your asset allocation. Based on your asset allocation, your allocation to CCP and rising giants and little champs should follow suit. There could be some opportunities in terms of rebalancing should a particular asset class go completely out of whack with your original plan. But beyond that, we wouldn't recommend entry and exit based on your views on what's likely to happen in the future. So now moving on to other questions about the portfolio. Ashwin, one of the questions investors are asking is, this clearly has a far greater B2B element to it. There are, of course, 2-3 B2C stocks. Is there something to read across from the performance based on this B2B skew in rising giants?
No, so basically, if you look at the 10-year time period horizon, I think, I'll just go to that slide. Yeah, so when you look at these numbers, whether it is the operating profit growth or whether you look at the RoCE, for example, it has been consistently above 20% across different time periods. So when you look at the long-term fundamentals, I don't think there is any kind of impact because of the B2B nature of these companies. But again, whether it is B2C or B2B companies, our philosophy is basically to invest in market leaders or dominant companies. So even if you are B2B, but if you are a dominant company supplying 70-80% of that component to the auto OEM, or whether it to the to your end user consumer, I think you hold a lot of bargaining power. So I think that is the kind of the key. So how dominant you are you replaceable? If you're not, then I think a lot of the pricing power rests with you. For example, take the case of GMM Folder. It's a B2B company, but commands 55-60, or now with acquisition of the competitor, it has almost 65-70% market share. But it's hard to believe that a pharma company or agrochemical company would kind of pressurize. Would be able to pressurize GMF Folder, whether it is on the pricing or whether it is on the kind of the trade terms actually. And also one thing, it was not designed, but by default, most of these companies, the parts they supply or the products they supply in the value chain, it's not very significant, whether it is alkyl or whether it is GMF Folder. So it may not be more than 4 to 5% of your end product cost or your capex. So as a result, incentive for the end user industry or the customer to go in for another player with cheaper pricing. I think the incentive is also not there, because if you go in for a cheaper pricing option, but if the quality turns out to be bad, I think there is a huge business risk that you could be facing again. So as a result, we think that despite these companies, most of these companies in the B2B segment, I think the bargaining power is in the hands of these companies. maybe, one, obviously, maybe one, again, I don't know, but maybe, supply chain is something probably, which could be a factor in the near term. Uh, Maybe B2C, again, not sure, but maybe, supply chain is something which probably could be a factor in the near term for B2B companies.
Right. So that brings us to the next question. Quite a few people have asked about the auto sector, auto ancillary. We naturally have exposure to Suprajit, but we have exited a few auto ancillaries in our Little Champs portfolio. And also, they're making the point that the auto sector has been jammed by the supply chain issues around semiconductors and other auto parts coming in from various parts of the world. How do we see the auto sector in general, and how do we justify our position in Suprajit?
Yeah, I think obviously we also learn over a period of time. But I think generally speaking, auto sector should come back. Again, it may be a 3-month or 6-month, but again, when you look at the two-wheeler, it's kind of a quasi necessity in India. Similarly, passenger vehicle, I don't think it's a saturated segment. So eventually, auto sector has to make a comeback. But when you invest in an auto ancillary, again, there are some, I think, parameters that one is to look at. One is obviously, again, the market share becomes very important. If you are one of the many players supplying a particular part to the OEMs, I think you have a lower pricing power, bargaining power, etc. So you need to be a dominant supplier. Secondly, again, auto ancillaries, you need to be very efficient because end of the day, it's like you are buying from steel companies, you are processing and you're supplying to auto OEM. So the room for you is very less. So the company has to be very efficient. It has to be very frugal. That is where you basically make the margin much higher than the peers. It all boils down to your efficiency, because I don't think the pricing per se would be different between one peer to another peer, much gap between that. But efficiency is where, kind of differentiates a good auto ancillary company. Frugality, that is what differentiates a good auto ancillary company and a mediocre auto ancillary company. And third is obviously, I think there will be immediate shift to electric vehicle. So how, what is the kind of disruptions that can happen to your existing business? Is the management thoughtful about it? Are they taking steps, to kind of mitigate those impact? I think that also becomes more and more important in auto ancillaries. In all these three aspects, we think Suprajit kind of fits the bill. As far as its core business is concerned, it has more than 55-60% market share in the domestic cable business. So clearly, it has got a reasonably good pricing power. So very efficiently run organization, makes EBITDA margin close to 17-18% in the core business. I think substantially higher than the second largest player. Very frugal. If you look at the gross block turnover, I think one of the best in the auto ancillary companies. Also, more importantly, management is cognizant that there could be some impact on the automotive cables from the electric. So there is steps being taken by the company. For example, they started around 4 or 5 years back. They started a new technology center called Suprajit, STC Suprajit Technology Center in place, and it has started churning out new products, which can go into the EV segment also. And last they disclosed that they got order of almost 100 crores. So again, thinking management, and also Suprajit has been very good in diversifying their business. For example, 10 years back, almost 90-95% of their revenues used to come from two-wheeler segment. Now with the recent acquisition, once it is onboarded, I think that exposure will come down to say 25-30%. So they have done a very pretty good job of diversifying across segment, across markets. And again, on capital allocation, they have been right on the money. So Suprajit has been been very correct on acquisition as far as Westcon is concerned, as far as Phoenix Land is concerned, and hopefully with Kongsberg also. So again, I think it kind of ticks the boxes on all these important parameters.
Right. So look, for those who don't know, Ashwin has been a career auto sector analyst. So he knows a little bit about auto. Even then, none of us are in a position to predict the auto cycle. The auto cycle looked for a recovery just before the pandemic, having been through 3 years of downturn, and the pandemic obviously has thrown a spanner in the works in terms of the supply chain issues. Having said that, I think if you stick around with high quality companies like Ashwin mentioned, in terms of the factors that make a high quality company, you should eventually be in good hands and achieve a reasonable outcome over the long period. Ashwin, of course, a topical question. I know you addressed it somewhat in your presentation, but worth delving deeper. Impact of inflation and hence high raw material prices, and also the subsequent follow through in terms of central bank action on rising interest rates, and therefore the impact on Rising Giants portfolio companies.
So again, on the inflation side, commodity price inflation, it did impact the quarterly results of some of the companies. For example, third quarter, you'll find that obviously there is also a supply chain impact in some of the companies. It did impacts the earnings or the margins in the short term. But again, as I said, like looking at the history of these companies as far as pricing power is concerned, I think it gives a lot of confidence. So they will be able to pass on. In fact, many of these companies, as it's like at the beginning, there is a automatic pass-through on the raw material. So maybe that is an advantage of being in a B2B company. So there is an automatic. Obviously, it doesn't cover some of the costs like power and fuel, etc. But most of the raw material prices are covered in that agreement. And if you're stronger, if you're dominant, I think you can even enforce it much better. So honestly speaking, we don't see much challenge, provided the commodity kind of settles somewhere, even if it is an elevated level. If it settles at an elevated level, I think the margin should come back. But if it keeps on climbing, I think we need to probably, there will be a catching game which will happen. Having said that, in the last 2 months or so, we are seeing some stabilization, even if it is at a higher level, but there is some stabilization which is happening in the commodity prices across the board. If it remains at this level, hopefully in second quarter, I think the margin should revert back for these companies. History suggests that, and we think this time it will be no different.
And interest costs, Ashwin, worth stressing on the balance sheet strength of these companies.
So interest cost, honestly speaking, obviously secondary effect हो सकता है, but most of these companies have, in fact, if not all of these companies have actually net cash on their balance sheet. So because of the filters that we used for selecting the companies, by default, we don't invest in companies with high debt equity. Maybe the max debt equity of any portfolio, non-financial portfolio company would be 0.5x. I think that would be GMF holder. Even after making 4 acquisitions, the debt equity is something like 0.5x. Otherwise, most of the companies have surplus cash on the balance sheet. So interest cost, they don't, honestly speaking, directly have any direct bearing on the financials of these companies. In fact, actually, it could be advantageous. I think Saurabh keeps on saying this because the peers operate with very high balance sheet with, again, a very low margin. I think the peers would really struggle, which is advantageous in a way to these companies, Rising Giants companies.
Right. Quick one. I'll take, FIs are selling out consistently in India. How do you account for that in your portfolio construction? Short answer, we don't. We don't account for that. We have, FIs buying, DI buying, or anybody else buying or selling is absolutely not a factor in our investment decision making. The only factors are the fundamentals that Ashwin has been talking about and will remain so. Getting back to the longevity and hence valuation aspect, Ashwin, there's a relevant question about how in these times when there's so much of disruption, where business cycles are shorter, how can you give yourselves the confidence that these companies can grow at a certain rate, say 20% over the next 20 years, to be able to arrive at that fairly high intrinsic value? How do you deal with that?
Obviously, there is a separate provision within our framework for disruption. So again, you will never have the right answer But we look for signs of it. For example, in case of Supreet, I mentioned that there will be some disruption in their core cable business. So what are the mitigating factors that are being put in place? So I think that is one example. We look for signs that, first of all, I think the biggest sign is if the management dismiss you about disruption. I think a lot of answer can come from interacting with management. What is their thought process basically? And looks for signs of companies are thoughtful about it. They are actually trying to put mitigating factors in place. I think, and obviously it can come from annual report reading. It can come from speaking to people on the ground, interacting with management, and look at the track record itself. So obviously today we are talking about technological disruption, but in the history you'll find a lot of disruption in another way, basically. So how did the management behave during those periods? Also, I think good proxy would be look how did the management behave during crisis actually. So it may not be disruption crisis, it may be an economic crisis. But looking at these events in the company in the history, I think it will give a lot of conviction about how the management thinks. Are they on their toes always? Are they ahead of the curve versus the peers? I think we try to kind of build our conviction through this assessments.
Fair enough. So there's one question on InfoEdge. People are saying all their subsidiaries, which make up a large part of the valuation for InfoEdge, are loss making. How do you justify that?
So obviously, I think in InfoEdge, I think one problem is that everybody ignores their core business, which is is probably seeing the best period of its, given the so much need for people, recruitment, etc. I think RoCE is actually RoCE is seeing the best period ever actually in terms of the business growth is concerned. I think one thing, I think core business has to be given proper, I think, attention, I think. And speaking about the investment, I think, again, there is an, I think, Zomato and Policy Bazaar, they don't contribute, in my opinion, more than 15% of the valuation of InfoEdge at current market cap. So why is there loss making? Again, we have to understand that Zomato is at the end of the day investor. Actually, it doesn't have, InfoEdge is an investor. It doesn't have strategic control over the operations of this company. So I think that is where it is. How we go about valuing InfoEdge is look at the core business, give an independent valuation to the core business, which primarily comprises of RoCE. And then look at whether Zomato has in it to derive a decent IRR on its investment book. So far, if you look at the history of InfoEdge, and if you look at take into consideration the current market cap of Zomato, Policy Bazaar, and say the book value of the investment where it is not listed, I think Zomato has generated an IRR of more than 30%. And obviously, we go into depth about what is the driver of such high IRR, what is the investment style of InfoEdge, what is the team made up, etc. That is where we gain conviction and where we remain very convinced about InfoEdge capability. So this is how we look at InfoEdge, if it helps.
Okay. And a few questions on Cholamandalam. What is the sustainable competitive advantage or moat for Chola that we see?
So one is obviously, I think the underwriting skill remains one of the most important, things to look in any lending company. And when you look at Cholamandalam's track record, I think it's in terms of one of the lowest NPS, etc. I think. And their ability to move across different vehicle segments, I think, despite auto seeing one of the kind of the worst slowdowns in the recent years, if you look at Chola's vehicle financing book, they have been very pretty agile in moving, identifying segments where there is growth or where there is a kind of slowdown. For example, they anticipated that there will be slowdown in CV, and they kind of pushed finance more into the other segments, other vehicle segments. So I think that ability, I think very few NBS are able to replicate. And finally, I think the cost of funds, because of their parentage, I think whole Murugappa group, etc. I think that's an inherent advantage as far as the cost of funds are concerned. So good. As a result, they are able to earn very good spread. Cost of funds are on a lower side compared to a standard NBFC, while they earn very good yields on the vehicle financing business. The company has recently forayed into new segments like consumer, SME, etc. I think that kind of opens up a big opportunity for them. So I think next 2 to 3 years could be very good, very interesting time for Cholamandalam.
Similarly, for the stock which has lost the most in the portfolio, Dr. Lal PathLabs, clearly witnessing a lot of new entry into the sector with the announcement of Lupin Diagnostics, Apollo Diagnostics, and so on. How can we be sure that Dr. Lal's will be able to sustain its competitive advantage in the face of this new entry, and therefore sustain the longevity which underpins its already high valuation?
Yeah, so it's not that Dr. Lal is facing competition for the first time. If you remember, like almost 3-4 years back, there was a spate of competition, for example, Metropolis, etc. I think the company kind of survived, not only survived, actually thrived through that period. I think one good thing about Dr. Lal is that it has always maintained that pricing discipline. So if I have not got it wrong, I think the price realization, if you exclude the COVID-related tests, I think Dr. Lal's price realization has grown by only 1% per annum for the last 5 years. So they have maintained a very efficient system, efficient setup. They have not taken price hikes, and as a result, I think there is a very little room for the competition to actually come, crash the price, and survive for a long period of time. It can happen that they can come and crash the price for 3 months, but to sustain that, I think it will be very difficult for the competition. And also, I think if the customers generally like, if the TAT is, customers are satisfied with the TAT, etc., and if the price is not obnoxiously high, I think there is also a lot of stickiness which is there.
I think in some ways it is intuitive as well. The entry of, or the consistent entry of new companies into a sector, in some ways, shows the attractiveness of the business. Right? So obviously, and this will be the case for most successful companies. The more money you make, you will always keep attracting competition. It is a given. I don't think people will enter telecom or airlines. I mean, although there are companies and airlines now, but the more money you make, you will always attract competition. So therefore, you can't wish away new competition. And hence our emphasis and what Ashwin and the research team has been doing is trying to figure out what are those unique capabilities of our investee company that makes it hard for all these new entrants. Health case diagnostics is a fairly long opportunity, given that historically it's been a fairly unorganized sector. There is an opportunity for more than one company to consolidate this sector, but Dr. Lal's is our preferred way of playing that sector. Relaxo in terms of top line growth.
Okay, I think Pramod.
Whilst a lot of other companies have demonstrated good numbers,
yeah.
Can you hear me?
Yeah, I understood the question. So I think obviously, there is a lot of negative impacts on Relaxo in this quarter. Obviously, there is a steep inflation in the commodity prices, and company has taken that price high. Plus, what has also happened is the GST has been increased on the footwear below rupees 1,000. So that has gone up from 5% earlier to now 12%. Straight away, there is a 7% increase. So, so as a result, there is a steep price hike, both because of passing of that commodity inflation as well as because of the GST. So it will take some time to adjust because end of the day, it is being used by people in the lower income strata. So obviously it is a necessity. So as a result, we don't see any structural issue because it's a necessity for because that is Relaxo is the cheapest footwear that you can get actually. So barring 1 or 2 quarters, well, there will be some, and also what happens like when there is a price increase, generally dealer also destock because suppose if they buy footwear at a very high price and if the prices, for example, come down tomorrow, they will be at a loss. So generally in an inflationary environment, also there is a destocking which happens. So this has impacted the recent quarter number of Relaxo. We don't see any structural issue. There is no market share loss by the company, and Relaxo continues to be the cheapest footwear in India thanks to their very efficient manufacturing setup, and hence we don't see any structural issue in the company.
Great. Next question is on Astral. Given that they've now announced their entry into sanitary ware, they got into water tanks. Years ago, they got into adhesives, although we have some history on adhesives. Isn't it a little bit of too much of a diversification too early? Are we concerned about it?
Not primarily because of two things. One is the ticket size. For example, the paint acquisition also, which Astral did, it's a 200 crores. So that has been Astral's kind of the ballpark figure. 200 to 50 crores is what they invest in. So in fact, the sanitary is a, I think, if I'm not wrong, it's a organic thing that they are building. So one is that the size is not big. Had the size been very big, it would have made us uncomfortable. But the size here, if you're talking about 200 crores, it's a cash generating business which they acquired. And also on the management bandwidth side, I think there, for example, they have bought a senior person to head the sanitary business. Similarly, the gem paints business which they acquired, the existing management will continue for the next 5 years. So as a result, till the time you're not compromising on either taking very big sized acquisition or you're compromising on the bandwidth, I think we should be fine actually. And also what gives us comfort is the track record of Astral as far as acquisition is concerned. I think the Resinova acquisition really is a good case study. Pramod?
Sorry, I was mute. The last stock specific question is on LTTS, L&T Technology Services. Obviously, has also been weak. How do we see the moats in LTTS and the investment rationale, particularly compared to something like Tata Elxsi, in the same space of outsourced engineering services?
Yeah. So LTS actually, if you look at their recent quarter results, actually I was trying to find any weakness. I couldn't actually find any weakness in their results. I think they are seeing actually very healthy growth. Double-digit growth is across all the major segments, whether it is automotive, transportation, or whether it is industrials and so on. The order book also remains pretty good. So actually, I'm not able to understand the fall in the prices. I think it's pretty baffling, why the market is punishing the stock. I think structurally we are seeing very good tailwinds for ER and the services. I think Hitarto, till the time the Indian I think landscape was not tested, I think the global customers were little bit holding back on giving this outsource engineering orders. But in the last few years, as I think thanks to LTTS, Tata Elxsi, I think the global customers are really opened in terms of outsourcing, not only in terms of the number of the clients, but also the terms of order size. So I think the industry, there is a lot of tailwind that is also reflected in LTTS results. And in terms of advantage, obviously, I think L&T parentage I think it gives a lot of advantage in terms of legacy, in terms of building customer comfort. Also, obviously, we don't do a relative comparison. Not that we generally stay away from doing a relative comparison because of Tata Elxsi and LTTS. We try to evaluate LTTS on an absolute basis. I think also what I think advantage LTTS is pretty diversified actually across different segments. For example, Tata Elxsi has a higher share to higher customer concentration. It has a higher exposure to transportation segment, whereas LTTS has a pretty much diversified customer base as well as diversified segment. Yeah, I think beyond that, actually, the fundamentals are on a pretty strong wicket for the company.
Yeah, I think that's a
Pramod, you are breaking up.
Pertinent point that Ashwin makes, which is applicable to the rest. Ashwin, am I audible now?
Yeah, go on.
Okay, so I don't have any questions, but I just wanted to conclude, explain stock prices in the short run. Often disconnected with fundamentals in the short run. This is not the first time, which is why we do understand it's done, because ultimately the stock portfolio dwindle. It is like an easier said than, but it is an important asset, and stayed invested in good companies. To be able to figure out whether the good companies or not, we are here to supply you with as much information about the fundamentals. We're being totally transparent through these webinars and our newsletters, and hopefully access to that information will improve your beliefs in the fundamentals, and hopefully that will help you give the patience and stay invested through these times. And that'll answer several other questions around, should we redeem and get back in when things stabilize? I don't think we'll ever be able to say in foresight when things will stabilize. It'll always be in hindsight that we know that we've seen the bottom. So the only way to make money or create wealth through equity investing is by staying put. Now, of course, you need to question the fundamentals of the company. You need to question the fund manager, and we're more than happy to take as many questions as possible. I know, given the paucity of time, we've taken most of the questions which are relevant, but if you have further questions, feel free to write to us at sales@marcellus.in. Some of you have expressed interest in investing in some of the other portfolios. Sales@marcellus.in is the best ID to write to, and we'll be happy to be of assistance on that. So thank you for being patient, and hopefully we'll come back to you next month with more smiley faces on the portfolio. But that's the nature of the beast, and look forward to seeing all of you again. Thanks, Ashwin, for this lovely webinar.
Thank you, Pramod. Thank you, everybody. Take care.